The morning sun hadn't even risen when portfolios across the world began bleeding red. Silver, the precious metal that had been confidently trading near the psychological barrier of $83 just hours earlier, suddenly plummeted into what can only be described as a financial nightmare. Within minutes, the price had collapsed to $73. 72, representing a catastrophic 14% decline that left traders staring at their screens in disbelief. This wasn't your typical market correction, where investors gradually reassess value over days or weeks. This was something far more sinister, a calculated demolition job executed with surgical precision during the darkest hours when most of the world was fast asleep. Understanding what truly happened requires looking beyond the sensational headlines and diving deep into the mechanical underpinnings of modern financial markets. The crash didn't occur during normal trading hours when New York's exchanges were buzzing with activity. It didn't happen during the London fix when European traders were at their desks. Instead, this financial earthquake struck at exactly 2 hours in the morning Eastern Standard Time, during what traders call Ghost Week, that peculiar period between Christmas and New Year's when the financial world operates on skeleton crews and holiday autopilot. The timing wasn't coincidental. It was absolutely critical to what unfolded. Consider who would actually be trading silver at such an ungodly hour during the final week of December. Retail investors in Ohio were tucked safely in their beds, dreaming of anything but commodity markets. European stackers were enjoying their midday meals, oblivious to the chaos brewing across the Atlantic. Pension fund managers had abandoned their posts for ski slopes in Aspen, trusting that the markets would behave themselves during their absence. The order book, that crucial digital ledger of buy and sell orders that normally provides a safety net for falling prices, had become paper thin. The bid stack, which typically acts like a cushion catching declining assets, had virtually disappeared. The market had become a ghost town in every sense of the word, and that's precisely why the massacre happened when it did. What transpired at that early morning hour was the implosion of a major institutional whale, likely a heavily leveraged hedge fund or prime brokerage client who had been playing with fire. This wasn't a case of losing a bit of money and deciding to cut losses. This was a complete breach of maintenance margin requirements, triggering what's known in the industry as a forced liquidation event. When institutional players cross that red line, there are no courteous phone calls from brokers politely requesting additional collateral. Instead, a cold, emotionless algorithm springs into action, programmed with a single relentless objective to close positions immediately and restore solvency at any cost. This risk engine operates without sentiment, without consideration for optimal pricing, and without regard for market conditions. It doesn't care whether silver is trading at $83 or $73. Technical support levels, relative strength indicators, and chart patterns are completely irrelevant to its programming. The algorithm simply executes market orders continuously until the account returns to safe territory. When this digital executioner activated at 2 a.m. and began flooding the market with sell orders, the result was predictable, yet devastating. In a normal market with adequate liquidity, these orders would have been absorbed by waiting buyers. The price might have dipped modestly, perhaps 50 cents or $1 before stabilizing. But in the desolate landscape of early morning Ghost Week trading, there were no buyers standing ready. The machine sold its first 1,000 contracts and watched the price drop $1. It searched desperately for additional buyers. Finding none, it dropped the price another $1, hunting for liquidity that simply didn't exist. The selling continued relentlessly as the price cascaded downward through $80, then $78, then $76. This phenomenon, known as a liquidity cascade, resembles a grand piano tumbling from a skyscraper window. Once it begins falling, nothing stops it until it impacts the pavement below. For silver, that pavement materialized at $73. 72, the precise point where the algorithm finally located enough desperate buyers to clear its massive position. When examining that enormous red candle on trading charts, the instinctive reaction might be to interpret it as a bearish signal indicating the end of a trend. That interpretation would be catastrophically wrong. What that candle actually represents is a forced liquidation, a margin call of epic proportions, where the seller had no choice but to dump positions at whatever price the market would bear. This distinction is absolutely crucial. If investors were voluntarily selling because they believed silver had lost its value, that would indeed be bearish. But when an algorithm is mechanically selling because a gambler went bankrupt, that's paradoxically bullish for everyone else still in the market. It means weak hands have been violently shaken out, excessive leverage has been purged from the system, and the overhang of that whale's massive position has been eliminated forever. The destruction didn't end with just one whale's demise. The initial dump triggered a secondary explosion that poured gasoline on an already raging fire. As prices began their freefall through key levels, another beast awakened within the computers of market makers and options dealers. This beast goes by the technical name of gamma, and understanding its role is essential to comprehending why a bad situation transformed into an absolute disaster. When the dying whale started dumping positions at 2 a.m., the banks holding the other side of those trades suddenly found themselves trapped in a mathematical nightmare. They were short puts and long gamma, and as prices crashed, their gamma flipped negative. Negative gamma creates what traders call a doom loop. For every dollar the price drops, banks become mathematically forced to sell additional silver to hedge their books. The price drops, forcing banks to sell, which drives prices down further, forcing even more selling. This vicious cycle transformed a correction into a full-blown crash within seconds. The dealers became forced sellers alongside the liquidating whale, chasing prices downward into the abyss, essentially cannibalizing their own market because risk models demanded it. The entire process was a robotic feedback loop of destruction, an automated spiral of death playing out while the world slept peacefully. Looking at that 14% loss with clear eyes reveals its artificial nature. It was created by a vacuum of buyers colliding with a surplus of forced robotic sellers. The crash had absolutely nothing to do with silver's fundamental value. It ignored the fact that solar panel manufacturers desperately need silver for renewable energy infrastructure. It disregarded the reality that silver mines are running low on easily accessible reserves. This was purely a plumbing failure in the financial system's infrastructure, and like any burst pipe, someone had to rush in to fix it before the entire house flooded. That emergency response came swiftly as the price touched $73, $72, and the system began experiencing dangerous tremors. The clearinghouses, those entities guaranteeing all trades in the futures market, suddenly realized the exploding whale might not be able to pay its obligations. If the whale defaulted, the clearinghouse would be on the hook for billions. And if the clearinghouse itself failed, the entire financial system would face catastrophic risk. This is where the narrative shifts from a simple flash crash to a desperate systemic rescue operation. Right at the absolute bottom, just when it appeared silver might plunge towards zero, massive liquidity materialized seemingly out of nowhere. The amount was staggering, a $34 billion emergency injection into the overnight banking system. No press releases announced this intervention. No central banker gave speeches explaining the action. But for those who know where to look, the fingerprints are unmistakable. Examining repo market data and overnight swap lines between central banks reveals the telltale signs. Someone with enormous resources stepped in decisively. Someone plugged the rupture in the financial plumbing, and that someone wasn't retail traders heroically buying the dip. It was the heavy hand of the system itself, protecting its own survival from complete collapse. This $34 billion figure is the key to understanding why the bottom has been established. It proves the crash wasn't merely allowed to happen naturally. It was contained through aggressive intervention. They permitted the whale to die, but they saved the ocean it swam in. Now that we know the plumbing held under extreme stress, we can examine the aftermath and identify who remains standing. More importantly, we can study the one market that utterly refused to crash, the market that witnessed this 14% drop and responded with complete indifference. While New York burned in the pre-dawn darkness, Shanghai was operating in a completely different reality. The gap between the paper wreckage in Western markets and the physical reality in Eastern markets had just exploded to a level guaranteeing this story is far from over. Following the money to where actual metal resides reveals a truth the mainstream financial media desperately wants to ignore. That truth centers on the $34 billion number, the massive sandbag thrown into the overnight banking system to prevent the levee from breaking completely. When a crash of this magnitude occurs, when an algorithmic shock sends an asset plunging 14% within minutes, it doesn't just hurt those holding positions. It threatens the very existence of the clearinghouse infrastructure. Consider the mechanics carefully. For every long contract the exploding whale held, there was a corresponding short contract on the opposite side. When the whale imploded and couldn't meet margin calls, a financial black hole opened in the ledger of the Chicago Mercantile Exchange. If that whale defaults completely, unable to pay what it owes, the clearinghouse itself becomes liable. And if the clearinghouse fails, the entire futures market spanning everything from oil to treasury bonds freezes instantly. At approximately 3:30 in the morning, right as prices were hammering against that $73 floor, alarms began screaming at the Federal Reserve's overnight desk. They observed stress in the repo market escalating rapidly. They saw counterparty risk, the fear that trading partners won't fulfill obligations, spiking to levels unseen since March 2020. Banks stopped lending to each other, unwilling to touch the toxic waste flowing from that liquidation. That's when the fire hose turned on full blast. The $34 billion emergency liquidity injection flooded the repo market, but let's be absolutely clear about what this means. The Fed didn't buy silver directly. They didn't care whether silver went to $0 or $1,000. They bought stability. They flooded the system with cash to ensure solvent banks had enough liquidity to absorb the whale's carcass without going bankrupt themselves. They effectively lubricated the gears so the machine wouldn't seize up from the friction of the crash. This massive injection was the invisible hand that caught the falling knife, stabilizing the bid stack and giving market makers confidence to step back in and quote prices again. Without this intervention, we wouldn't be looking at $75 silver right now. We would be looking at market closures, limit down trading halts, and broken trades across the board. The fact that authorities had to intervene with that much capital reveals everything about how fragile the paper silver market truly is. It's a house of cards, constructed on leverage, and strong winds blew hard through it. The only reason it's still standing is because the central bank propped it up with a wall of freshly created money. But here's the sick, twisted irony of the entire situation. While Western financial systems frantically printed $34 billion to patch a hole caused by paper derivative explosions, the physical world watched and laughed. While paper prices crashed, actual metal behaved completely differently, bringing us to the Shanghai reality check. If you want truth about a crime, you don't ask the criminal, you ask the witness. The witness to this crash is the Shanghai Futures Exchange. While New York was destroying wealth, China was pricing silver as if nothing had happened. Looking at Shanghai, closing data reveals the front month silver contract closed at 20,073 yuan per kilogram. Converting this to Western terms tells an astonishing story, dividing by the exchange rate of roughly 7, euro 4, and then by 32. 15 ounces in a kilogram yields $89, 18 per ounce. The disconnect is staggering. In the West, the price sits at $75 because a hedge fund blew up and the Fed had to rescue the repo market. In the East, the price remains near $89 because they actually need silver to manufacture solar panels and military technology. The spread between these two numbers has reached $14. This isn't a minor market inefficiency. This is a broken market screaming its dysfunction. A $14 spread on a commodity is economic insanity. It means for every ounce of silver held, the Chinese market values it nearly 20% higher than the American market. Why isn't arbitrage closing this gap? Why aren't traders buying at $75 and selling at $80? Because they can't. The January 1st export licenses have built an impenetrable wall around China. Metal in Shanghai is trapped. Metal in New York is scared. The two prices have completely divorced from each other. This $14 premium is ultimate proof the crash was artificial. If genuine silver glut existed, if supply truly exceeded demand, prices would be dropping in Shanghai too. But they're not. They're holding firm near $90, which proves the New York drop is purely synthetic. A paper event, a story told by algorithms to other algorithms. The physical market isn't participating in the crash. The physical market is saying it will gladly take all available silver at $75. This leads to the most dangerous lie being broadcast on financial news networks right now. Turn on any television, and what's the narrative? Retail panic. Mom and pop investors fleeing in terror. The silver bubble has popped. They're blaming ordinary investors, trying to convince everyone that this 14% drop resulted from thousands of small investors waking at 2 a.m. simultaneously deciding to sell their coins. It's insulting, fabricated, and the data proves it's completely false. Flow data from ETFs and volume data from coin dealers tells the real story. Retail investors didn't panic sell. They bought aggressively. Inflows into silver ETFs spiked dramatically. Bullion dealers report record website traffic. The little guy saw a sale and backed up the truck. The only entities that sold were over-leveraged institutional whales caught exposed. The supposedly smart money wasn't smart. They were reckless and got liquidated. The supposedly dumb money, the retail stacker, was buying the dip intelligently. Don't let the narrative shake you out. This wasn't a vote of no confidence in silver. This was a margin call at the casino. The casino had to liquidate a player who couldn't pay debts. But the chips, the silver itself, remain valuable. In fact, they're more valuable than ever because they're now in stronger hands. Every ounce sold by that bankrupt whale is now owned by someone who isn't leveraged, someone who won't be forced to sell at 2 a.m. The market structure has been cleansed. Weak hands are gone. Leverage is flushed. What remains is a market primed to explode higher when institutional desks return from holiday vacation on January 2nd.